Welcome to Subramani. I'm going to talk about a risk called concentration risk, which many people don't even understand or comprehend. Let alone plan for it. Let us take the case of. Let us look at some international examples of what happened and how concentration risk really got their goat. So first, of course, the greatest example is LTCM, long-term capital management, right? So let us look at the details of what happened. I mean, just a small piece on what happened. In 1998, LTCM lost, I think, about $5 billion. Must have been a big sum in 1998 because they had concentrated bets on interest rate swaps. Now, when you have interest rate swaps or when you have GSEC, you never ever think that this can run out of liquidity. Now, it's very important to understand that when you have a specific asset, liquidity does not really matter, because you could have, it would be a fantastic asset. I mean, the greatest example is Vanderbilt. They sold their real estate at 1% of the price at which they had bought, or with the cost of construction, 99% haircut. What happens in a concentrated asset is that particular asset has to be sold. Now, if you have a index, good chance that the index will have more liquidity than a particular share. But what happens is, you have heard this very often, concentrate to create wealth and diversify to preserve wealth. Sounds very good, but sometimes it is true and many times it is false. Now, take the case of those people who had shares of Satyam, and the market fell. I think Satyam shares fell to 8 rupees, 9 rupees, maybe 18 rupees. I remember buying and selling. But the thing is that risk ever understood? Do the shareholders of Axis Bank, or maybe even Yes Bank, I'm not sure, or Infosys or HDFC even realize the risk that they are taking by accumulating the ESOPs that they get, and to such an extent that the shares are worth maybe 90% of their net worth or 80% of their net worth? Answer is no, because they get very fond of the company in which they are holding the shares, and then they cannot even accept that it goes nowhere. In the last 3 years, more people have called me from HDFC Bank saying, what should I do? Should I hold on to HDFC Bank? Should I hold on to HDFC Securities? Should I hold on to HDB, which is another unlisted company? HDFC Securities, again an unlisted company. They still have a secondary market happening in HDFC Securities, but I don't know how long, simply because ICICI Securities got listed and then they realized it is not worth listing a broking company. It is very profitable. Let's keep it private. So what happens if HDFC Securities doesn't get listed at all? What happens if HDB doesn't get listed at all? Then there is this liquidity risk that, okay, suddenly you will have a big concentrated chunk in your net worth, but that you may not be able to sell. Just not be able to sell. There is no question of price. Then will you sell it at 1% of your cost, like what the Vanderbilt had to do, right? So that is the question that you have to ask yourself. The other example is Lehman Brothers. I think Lehman Brothers is 2008 story, where they had mortgage-backed securities. You know what happened to the real estate market in the US, and in 2008 Lehman filed for bankruptcy. That's it. When you have a concentration risk on a illiquid asset, this is the worst combination, right? Like having too much of debt paper in Diwan housing or something like that, you're finished, right? Maybe 20% of your portfolio is Diwan housing. The overall NAV of that fund will take a huge hit. Then this is the worst thing that you're doing. You're combining concentration risk and liquidity risk. Now, if you have shares of Reliance, or if you have paper of HDFC Bank, or something like that, then there is lesser worry for you. But If you have taken a concentrated bet in in say Shriram Finance, and Shriram Finance and the NBFCs are not doing well, then suddenly your bonds in Shriram Finance, which were AA plus or AA, is suddenly illiquid, and you will just not be able to get rid of it. I've seen people struggle with lesser known companies where they have just got to take a 20% haircut or 15% haircut. All the premium of extra interest that you got is completely wiped out in one deal like this. So this happens when you take a concentrated risk. Take the other example of what happened to an investor called Bill Hwang, HWANG, in 2021. He lost about 20 billion when the shares in which he had taken a concentrated bet went down. That's it, simple. In 3 days he lost 20 billion on a not a very big base. So similarly, these kind of stories do happen. People don't understand or realize the risk they are taking. And one more thing which happens, which I have seen, is people with concentrated portfolios, for example in ESOP, they just don't sell. They just keep accumulating, saying my company is very good, so nothing will happen, in spite of seeing things like what happened to Satyam. Now Satyam is again a super exception to the rule that the company got revived. In India, chances are once a company has a problem, once you see one cockroach, good chance there will be hundreds of cockroaches and it will never get revived. Luckily for Satyam, whatever, I mean, Satyam's story is very long, it's not as clean and great as it looks like, but whatever it is, at least the shares got revived, because the company got revived, so the shares went up again. But if you had panic, which is what you should have done when the share price reached 18-19 rupees, you should have sold, because you never knew that this is going to happen. But in retrospect, it is easy to say, look, this is what happened, the company got revived, so I got saved. What happens if the company in which you have invested, which you have 20%, 80% of your portfolio, what happens if it falls 20-25%? Will you have the presence of mind to sell and say, I'm still way above my cost, so let me just sell it off? Or will you say, no, this is temporary, nothing can happen, nothing can go wrong, and be in denial? We don't know how we are going to react at the time of a crisis. Take another case, SVB, right? The SV Bank, or I think the SVB Bank, or whatever the name in US is. Here was a company, here was a bank which was funding startups. Now look at the balance sheet. The balance sheet has got G-Secs, safest assets, right, which is where it has invested. Obviously it is getting money, which is the liquid money which is coming from all these startups to whom you are lending. You're taking money from some startups and you're lending money to some other startups. Look at the balance sheet on the asset side. There are only two assets. One is there is a GSEC, and one is monies given to startups for doing their business. When startups are funded by XYZ, they obviously keep their money in SVB, and so that was your source of funds. Now, when interest rates started going down, this great genius of a bank did not do a mark to market on a monthly basis. I would have done on a daily basis or a weekly basis, because 2022 interest rates went and went up, and the GSEC portfolio just went south. They could not have got rid of the portfolio, and they lost money on a MTM basis. This is inexcusable, because the minute interest rates went down, they should have started providing for it. It took them about a year to go bankrupt, but it was so foolish. They did not do an MTM of the biggest asset that they had, which is ridiculous. No auditor should ever sign a report because you are not showing a true and fair view. You are saying, oh, I'm going to hold it to maturity, it doesn't matter. It does matter if it is a big chunk and you have a liquidity crisis, you are unable to sell. Now, if I have a portfolio of 30 crores and I have, say, 25 lakhs in GSEC, which is, and I don't do a mark to market, it should not matter at all, because what I have is an extremely small percentage of my portfolio. However, if I am doing a business where I could require liquidity, in fact, I will require liquidity, simply because the people who bank with me are people who are startups, who will panic when they see that they don't have liquidity, so they will want to keep the money in the bank. But the minute they are afraid that something could go wrong with the bank, good chance they would want to transfer money from bank A to bank B, and that is where it started hurting. So more and more people started shifting, and so you had to do a sale. You said you were holding it to maturity, but that is what you thought. The market did not think so. So SVB was suddenly having to sell its GSEC portfolio in a market where interest rates were going up. Fairly obvious, they took a huge hit, they went bankrupt, they got rescued, is a different thing. But when your balance sheet has two very concentrated assets, one is GSEC and one is lending to startups, both could turn illiquid, right? When you lend to startups, there's no chance that you can recover that money quickly. And when you lend to GSECs, you have got to remember basic rule. If that money is kept for liquidity, it has to have a mark to market on a weekly, monthly basis, whatever. You can't wait for the whole action to pan out and say, oh, we have suddenly gone bankrupt. You didn't suddenly go. And SVB is not a small bank. The bank is bigger than HDFC Bank in terms of size. This was too basic a mistake. So similarly, if you have a concentrated portfolio, it looks like, wow, that's the way to make money, because whether it is a Bill Gates or a Warren Buffett or a Mukesh Ambani or a Nazim Premji or a Narayan Murthy, they all created wealth in the concentrated part of their portfolio. I'm not saying that they had other shares, did not have other shares, I'm not getting into it, but largely the wealth creation happened by sitting on their own shares, going through good times, bad times, etc., right? But then afterwards they may have diversified, but initially they had a very concentrated portfolio. They got lucky because they got successful. Think of those companies which did not succeed. It was so easy for me to rattle out HDFC Bank and Wipro and Infosys, etc. Think of those companies which did not make it to the end. So I know of startups where people went and worked for a salary which was zero salary or very low salary and completely depended on ESOP. Then the CEO and the CIO got married or got divorced or etc. For whatever completely extraneous reasons, the company got dissolved, and these people were put in 10 years of their experience and sweat into the business, completely lost it. Don't take that kind of a risk. Thank you.